You've set up your trade. You go to execute on a common ETF like SPYG, and a red closing only warning suddenly blocks your screen. It's a gut punch moment. Your mind immediately jumps to the worst case scenarios. The asset is crashing, the company is fraudulent, or the entire market is unraveling. But if you check the broader exchanges, the market is actually functioning normally. There is no halt and no regulatory news. The restriction is occurring entirely at the broker level. To prevent your platform from secretly sabotaging your trading strategy, we are going to walk through a 4-step broker reliability assessment. Understanding why a broker chooses to lock you out is the first step toward maintaining control over your long-term capital. Step 1 is determining if the asset is legitimately in trouble, or if your platform has simply imposed an isolated lockout. Check your financial news feeds or the exchange boards for any official market-wide halts or regulatory issues regarding that specific ticker. If the news is quiet and the exchange is clear, and you see other brokers trading the symbol normally, the asset is perfectly safe. Safe assets like SPYG get restricted because they have lower volume and wider bid-ask spreads than massive funds like SPY. This creates a level of liquidity risk that some brokers are unequipped to handle. When this happens, the block serves as a clear indicator of the broker's internal risk ceilings, independent of the asset's actual market health. Now for step 2, classifying your platform based on how it handles that risk when the market gets stressed. Tier 1 brokers, like Fidelity or Interactive brokers, manage risk internally. They have deep liquidity access and the ability to hedge client exposure themselves. Because they manage risk within their systems, they rarely restrict clients from trading. In contrast, Tier 2 brokers, like Robinhood or Tastytrade, are built for retail engagement. They rely on external market makers and have tighter internal risk limits. When volatility rises, they protect themselves by locking users out of new positions. Moving a symbol to closing only is a defensive maneuver for the broker. It ensures their safety, but it leaves the individual trader stranded. A slick, simple user interface often masks this dangerous reliance on external liquidity, putting your trades at the mercy of the broker's internal bottlenecks. That brings us to step 3, assessing how vulnerable your specific trading strategy is to these sudden broker-level lockouts. Here, the penguins represent a strategy that requires unobstructed access. For instance, systematic in-the-money strategies, which focus on high-probability options deep in the price action, depend on precise entry points and the ability to act immediately when a signal appears. Now, compare that to this penguin leaping out of the water. This is the friction of a Tier 2 broker. Entering the market suddenly requires you to overcome unpredictable broker-imposed hurdles just to execute a basic trade. When you are trapped in a Tier 2 ecosystem during high volatility, you effectively lose control over your pricing, your timing, and your execution. A flawless trading strategy is useless if the platform you use to execute it abruptly revokes your permission to trade. Step 4 is running your platform through a broker reliability checklist. Item 1. Does the broker manage risk internally, or do they restrict clients during high volatility? Item 2. Is the platform built for capital-intensive trading or optimized for retail engagement? Item 3. Does your strategy depend on acting immediately on signals, regardless of liquidity spreads? If your strategy requires uninterrupted access, but your broker fails those first 2 checks, the platform itself has become an unacceptable execution risk. You now have an objective assessment to know with certainty if your broker is a liability to your financial goals. Market conditions won't always cooperate with your plan, but your broker should never be an additional enemy you have to manage. If your current platform failed the checklist, start researching a migration to a Tier 1 broker like Fidelity or Interactive brokers. Your greatest risk in any market should be the trade itself, not the platform you chose to execute it.